Ryan Newman, Director of Research at the Motley Fool Australia. How are you going?
Good, thank you, Owen. Thank you for having me back.
Well, I had to because the topic of today's podcast is 3 foolish stocks. So
You couldn't really do that with too many people from different businesses, I guess?
Yeah. And we'll go uppercase F for foolish, as in the Motley Fool Australia. You've been on the show quite a few times. One of your episodes, I regret to say, was very popular.
Yeah.
The one, it was how to be a pro analyst. We did it quite a few years ago on research and valuation techniques and those types of things. But today I'm going to ask you a few planted questions. I've got 4 of those. And then we're going to roll in with a few companies. You've got some Aussie companies and you've got one US company, which we will talk about in a little while.
Looking forward to it.
First question that's planted. Do optimists or pessimists make more money in the stock market?
Look, as a long-term investor, I almost have to say it's optimists. And I strongly believe that is the case. And there's actually a quote, I think it was by Peter Lynch, where he said, far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in corrections themselves. And I think that's a really important lesson for investors to take away, that these sort of corrections, which is technically a drop of 10% or more from the peak, corrections are inevitable in the market. And I think the statistics say they happen maybe once every 11 months or so. So we're looking at more than once a year. If you're an investor, you will absolutely experience corrections, sometimes even worse than that, bear markets, which is a fall of 20% or more. The idea, though, is that you need to invest through that. You need to maintain that long-term mindset to make sure that you are getting through those periods and continue to invest even in anticipation that they will happen. And I think to do that, you need to remain an optimist. I don't think you can do that while being a pessimist, because I think pessimists often will try to remain on the sidelines, stay more invested in cash, and they miss a lot of those opportunities on the way up. And that's really what we really try to profess at the Motley Fool as well. We don't deny that there will be stock market corrections. We don't deny that they will happen and that they will hurt. We try to tell our members and tell ordinary investors as well that they will happen, but everything will be okay. And again, I think that's a very optimistic outlook.
I think that's where because they say your first job out of uni is very impressionable upon you. And I think Motley Fool is basically my job in uni. And everyone is positive, but cautiously optimistic is probably the right word.
Well, we both joined the Motley Fool at about the same time. I think I was February 2013 or thereabouts, and you maybe a little bit after.
Yeah, that's because, just for a bit of context, for the mighty Bruce Jackson, who may be listening, when we saw the job ad come out for investment writers at the Motley Fool, we were worried that they wouldn't take 2 of us, so we both wrote under one name. This is a true story. Correct me.
It is true. I will say I was 100% responsible for those, making sure that everything was legit. That was under my name.
And then we discovered that the Motley Fool was growing really fast and they needed more writers. So we're like, happy days.
And come on board.
2 of us, and shout out to Robin Greery back in the day, who was patient with my grammar. Probably owe her a lot of...
with your grandma or grandma?
Both. But mainly my grammar. So I would just say Motley Fool, great organization, very optimistic. People probably get that in the name. So I want to get to these 3 companies, but I've got this second planted question, which is, what's one thing you learned in the COVID crash? And the reason why I bring up the COVID crash is probably the most recent example of a pretty significant downturn for people.
Yeah, I would actually kind of disagree with that. The other one was actually much shorter lived, which was the tariff drawdown.
The most recent.
That's the most recent. That was maybe 2 months ago, Liberation Day tariffs?
Yeah, I can bring that up maybe on the screen.
I think that was like the 2nd of April or something, I think was the date.
Yeah.
So very, very recent. We're filming this middle of June, so very recent. But look.
Yeah, that was pretty hectic.
It was, yeah. It was a very sharp drawdown.
Yeah, bought a lot more shares that day. I was very happy about that. Timed it.
Yeah, timed it almost to perfection, I think.
Yeah, not that we would say timing is important, but definitely it was lucky, I would say.
Well, it was jumping on opportunities, right?
Yeah.
And I think that is one of the lessons that I wanted to bring up from COVID. There's really 2, I suppose. One from an investing approach. So at that time, everyone had their own thoughts about what was happening, what was going to happen. people were panicking. This is something that hadn't happened to humanity in 100 years to this extent. And at that time, we watched a lot of fund managers who, very, very smart people, make some very big mistakes, trying to outsmart the market, trying to jump out of the market, which proved to be at the precisely wrong time.
Did you just say fund managers or fund managers?
Okay, now we're correcting on pronunciation.
Yeah, okay. Sorry, I just wanted to make sure.
Yeah, fund managers.
Okay, with a D. Yeah, got you.
Yeah, so look, a lot of those people got burned because they jumped out precisely when they shouldn't have. And of course, you can only know that in hindsight, but it goes back to what we were talking about a minute ago as well. By making sure that you remain optimistic, that yes, this is a tough period, but these things will pass. I will say from a personal perspective, I didn't go hard enough at chasing those opportunities at that point that I would have, or I should have. And I guess now zooming back to the more recent tariff collapse, which was much shorter lived, but still very harmful in the period. I did try to take that away, and I tried to recall, okay, this is how I was feeling through that COVID crash. I didn't go hard enough at those opportunities, and now I need to start taking advantage of some of these opportunities on offer. For me personally, that's not to say that I wanted to go all in. I'm always someone who likes to keep some cash handy because, one, it's a good hedge against further downside, but it is also good, in my opinion, good to have some spare cash should greater opportunities arise. I didn't know if the market would drop another 10, 15%. I personally wanted to have some dry powder to take advantage of that if it happened. So that's one of the lessons that I learned. From a business perspective as well, though, in terms of the businesses that we're actually analyzing and looking at, you really start to pay more attention to which companies are actually built to withstand these sort of stresses. It really clarified who's resilient by design, I suppose, their business model. So recurring revenue, net cash position, low customer churn as well. These are the businesses that could really thrive through that period. And if not thrive, at least survive. A good company at the time was IDP Education, and it's had some real issues more recently, unfortunately. Ticker code is IEL, not IDP for
IEL.
IEL, yep. So IDP Education, though, they were in a position where they had a very strong net cash position, and other companies within that industry. So this is really helping international students to find educational positions in international markets. So for instance, students from China wanting to study in America or wanting to study in Canada. IDP Education is really paving the way.
They do that like IELTS, IELTS or whatever.
IELTS, yeah. That's the English language testing, essentially. So a company like that, though, they were able to go full ball at developing greater tools for their students to use, developing greater relationships with those students so that when conditions did improve, they would be in a better position than their competitors, rather, to actually go after those opportunities. As I said, it has run into some real trouble in more recent years, but that was a good example of a company that was positioned to thrive through COVID.
So it went to, it kind of had a momentary fall of $21 down to like 13, but then immediately went straight back up to nearly $40.
And just to provide
now it's $3.
Now it's $3. And
yikes.
Just to provide a little bit more context there as well, after that initial dip mid-2020 or whenever it was, the rationale there was that governments relied heavily on education as an export. So no students could really come into those markets because of travel restrictions. But we thought, okay, a lot of these governments are going to try and open the borders and attract as many international students as they possibly can when regulations do allow for that. And I think that's really what did lead to a large part of that burst. In more recent years, we know that certain administrations in particular around the world have become far less inclined to welcome immigration and international students. And I think that has largely been the cause of that decline. So I think two very separate issues there.
Okay. My next one is you do a lot of valuation work, and we're here on the Australian Investors Podcast, so you can feel free to go as nerdy as you want on this next question, Ryan. Do you think AI will replace valuation processes or techniques? And I'm thinking about things like discounted cash flow analysis or other valuation methods that we've commonly seen in the finance industry and investment industry over the past, say, 3 decades?
I think this is a question that not only people in finance are facing, but also people in every industry. Mm-hmm. And I'll preface this answer, I suppose, by saying that AI is pretty incredible, what it's capable of now, and it is only getting better, right? So I don't want to completely discount it and say that, no, it will never replace something like that. I think, in terms of pattern recognition, data gathering, comparables, AI can do a fantastic job. What I would say about a DCF model and certain valuation models that I find most valuable, and probably the primary reason that I do a DCF, is because I've mentioned before that I'm very narrative based. And undertaking a DCF helps me to understand the company's story, not only where it's come from, but also where it's going. So I can pull things out from reports, I can pull things out from even just small comments that management have made that I can interpret myself to mean, okay, this is a company that is investing heavily in research and development, for instance, right now. I think over the next few years, that focus is maybe going to start to shift maybe towards more of a sales and marketing heavy approach. Or maybe they're getting to that point in time where they can actually start devoting a lower percentage of revenue to things like research and development. And that's where the margin expansion can start to come in. Right now, I don't know that AI is as good at a human at doing that. And I suppose that's to say that I think AI can do a fantastic job, but I don't know that it can ever necessarily fully replace a human being working in tandem with AI. Yeah. So maybe I can use AI to actually help me build my DCF, but I think it's always going to need a human interpretation to actually get the DCF to tell you what you're trying to understand.
It's really interesting, isn't it? Because most people probably don't know this, but I would say on average, more than half of the professional fund managers in Australia don't do their own valuation models. They rely on brokers to do the valuations for them. Yeah. And like third-party brokers. And you might be like, well, wait, what? Huh? So if you're a fund manager and you manage, say, $200, $300 million of people's money, what actually happens behind the scenes is the brokers, who are sometimes called dealers, they basically are operating in this world where they'll give the fund manager research and help them do their job if the fund manager places their trades through them and helps them earn a commission on the trades that they're placing. And when you think about that, it's really fascinating. But you'd be like, well, why does the fund manager need to use those brokers? Because if they try and buy a small cap company and there's not enough shares, they have to buy it from someone, and the broker knows that someone. So then it becomes this kind of like really interesting circle of interests, I would say.
You scratch my back and I'll scratch yours.
Yeah. And so a lot of the fund managers just rely on these templated things. And a lot of individual investors can go to websites that offer like really simple visualizations, charting tools, templated valuations. I'm in your camp here, Ryan, that actually what AI will probably do for a lot of investors is make building the model easier, but it doesn't make anything easier in terms of the inference that you would make as an individual. And that's why, just quickly, one more thing. We did a trip to Adelaide recently. Shout out to everyone in Adelaide. Thanks for the wonderful wine and everything else that's from Adelaide. But we were down there doing an event a few years ago, and a lovely lady did kind of get a bit animated, let's say. We did have to eject her from the venue. But she was convinced that there was an AI simulation taking place and it was invading the UN and all this sort of stuff. But interestingly, the gist of her question was like, is AI kind of taking over everything? And I said, when you see an AI walking down the street and purchasing products, that's probably the point at which you realize that as an individual investor, you probably don't have as much inference.
Yeah.
But up until that point, humans are still making decisions of which products to use, which services, which restaurants do they go to, which brand of toothpaste do they want to put in their mouth. And at that point, you can still have inference as an investor. That's just my 2 cents for what it's worth, that I feel like there's still the human element of investing in business is more alive than ever before.
Yeah, I read an interesting article actually on The Economist recently about why AI hasn't taken your job yet. Because, I mean, that's pretty much anyone you talk to in any industry is saying, if you still at your job, is AI doing your job yet? And I think most businesses have adopted AI to a certain extent, but most of them haven't replaced humans with AI. They're sort of using them in tandem. So sort of using it to collaborate with one another. You can use AI to enhance your thinking. You can use it to, maybe poke holes in your thesis or, things like that. But there, as I said, there will always be that human that still has to have that value input, I think. The other thing is as well, we've seen this happen with algorithms in the past where, someone might say, oh, this algorithm, it's designed, it's foolproof to get 15% returns per year. As soon as people start to follow that algorithm, it all evens out. It basically self-defeat. It's a self-defeating purpose in that sense. I think if AI was to start doing all these DCFs and all this valuation work, then again, there would be options and opportunities elsewhere that AI isn't necessarily looking at. I think there will always be opportunities in the market for those reasons.
I mean, there's so many places we can go with this prompt, but we do have companies to get to. I will leave people with one thing, which is that Seth Godin has this great quote that pros don't fear amateurs. And I think it comes in this form as well. It's like, I think people using AI to help them invest, on average, will probably get better.
Yep.
But the people that are really good at it don't have anything to worry about, at least not yet. Planted question number 4. This is a roll on from that one, my friend, which is if you had 2 days, and you only get 2 days, 2 days to research a company from scratch. You don't know anything about it, but I'm going to give you a company that you probably do know a bit about. Say a company like ARB, which is on the ASX. ARB is a ticker symbol. It does 4x4 accessories for people that don't know, bull bars, that sort of thing. How would you spend that time? So you're a professional investor, professional analyst. How would you divide that time to make sure that you're making the most informed assessment of the company's prospects?
Yeah, so again, I'll preface this by saying it's not a company that I've looked at closely before, but I do know of it, and I know some very good investors who do very much like this business. So I by all means think it's a quality company. What I would say again is, even though we've just been talking about DCF models and valuations, again, I'm very much a narrative-focused investor. Mm-hmm. So I would really want to start by understanding the business and where it comes from, what it does, who its customers are, the trends underlying that, etc. So in terms of understanding the business, I would spend the first day understanding that narrative. We spoke about annual reports, presentations, earnings calls and earnings transcripts. Those are really great resources to start to use, I think, to really build that knowledge of what a business does. I would suggest going back maybe 5 or 6 years with the annual reports and presentations, particularly using the presentations, I suppose, to analyze what are the key metrics that management think are particularly useful. Again, I don't know ARB's ins and outs. I don't know exactly what their key metrics are, but maybe same-store sales growth, for example. If you can understand that and you can start to pick those things up on the presentations, then maybe you can actually start to understand, okay, this is a company that continues to do well in this regard. You can start to build out that narrative, how it's done historically, and whether you think that trend can continue. The second day, I'll go into a little bit more depth there actually. I should say understanding the customer. Mm-hmm. Who are the customers? Companies like, a company like Lavisa, for example, that's probably more targeted at younger females. ARB probably more focused on middle-aged blokes who maybe not quite so price sensitive. They're happy to go out and spend because they love doing all this four-wheel drive stuff. So that can sort of prompt you to think, okay, during a recession, maybe it wouldn't be hit quite as hard as a lot of other retail businesses out there because of that demographic. So understanding the customer, understanding the pricing model, why people buy from it. ARB, my understanding is it's got very, very high quality gear that's reliable. Mm-hmm. You want reliable gear if you're going out camping and going out into the outback. So people would prioritize that quality and therefore more likely to go for a company like ARB. You'd want to understand the industry structure. Who are the competitors? How fragmented is it? Those are the sorts of things as well. I think you can pick up elements of that from reading through the annual reports and transcripts. You can understand it. Even just doing a search of four-wheel drive products. What are some of the other company names that come up?
Yeah,
you can start to do a little bit of digging in there. Maybe see where there's overlap in those companies. See where ARB may be focusing its attention, whereas others are focusing their attention maybe on a different niche. So just understanding that. And you can also, I think, achieve that by looking at forums, product reviews, YouTube videos. Pretty much a YouTube video for everything these days, isn't there? So,
yeah, there is, yeah.
Yeah, I think that's a really valuable resource too. That's day one, understanding the business. Day two, if I like the business enough that I like the narrative, I like where the business is going, I think it's got a good competitive advantage, those sort of things. If I can answer those questions with an affirmative yes, that's probably when I start day two with more of the financials. I use a resource called Cap IQ, S&P Global Market Intelligence. That is more of an analyst tool. I think it's about $7,000 or $8,000 a year. So it's
wow.
It's quite inaccessible,
Must
I suppose,
be nice.
for ordinary investors to use. But I will typically get a lot of the numbers from there. I'll clean them up a little bit, paste them into my DCF or my valuation model, and start to then project it forward. Looking at, okay, do I think margins can expand from here? Do I think sales can continue to expand? How much? If so, the market might be growing at 3%. I think the company can continue to gain market share. So maybe it can grow at 4% or 5%. I start to answer those sort of questions with the financials. As I said, looking at the operating leverage, returns on invested capital, and just build that DCF out. No valuation model is going to be perfect. I think if you are looking for precision, you're not using it right. Again, it's about understanding where the company is going and trying to get that ballpark feeling for what the company's shares are worth. I think if you do a DCF and say this share is worth $40.05 precisely, once it goes above $40.05, I'm going to sell. I think that's the wrong approach. I think you just want to know the ballpark figure. This is roughly what it's worth based on my assumptions, and carry forward like that. So that's how I would use the 2 days.
Wow. Quick follow-up before we get to the companies. Do you always use a DCF when you invest? You're pretty, you said narrative driven, but
I often use DCF. Sometimes I'll look at how a company compares to other companies in the market. So for instance, I'll go back to Lovisa, for example. Maybe I'll look at Lovisa and compare its price to earnings or its any other multiple really to other companies like Super Retail Group or JB Hi-Fi, just sort of comparing it to those other companies. You will sometimes find that a company might have a higher multiple, but it's justified. Maybe because it has higher growth, or maybe because it is more resilient in a down market. You need to sort of understand the narrative behind the company as well to understand when to apply those different rules and theories. So not always with a DCF, but I would say it is probably my preferred method.
Okay, good to know. All right, I'm going to give you 3 minutes, say, for each company.
Sure.
Which I know is rapid fire, but people can refer back to the Motley Fool website or whatever you use to get your informatia. I am going to be guided by you on the 3 companies. There's the 3 foolish companies because you're here today representing the Motley Fool Australia. Where do you want to start? Which company?
I am going to, actually I'll say all 3 of these companies I do own shares in.
Okay.
I will say.
Thank you for the disclosure.
First company is WiseTech Global.
WiseTech Global. I've heard of this because I own shares in it.
Yes, we've also spoken about it on a different podcast.
Yes, the Australian Finance Podcast.
Yes, so ticker code is WTC. This is a company that I've owned shares in. We established before for about 9 years, just after it IPO'd on the market.
So you have a 26 bagger on your hands or 2,600% return plus dividends?
My only mistake was not buying more.
Okay.
So either way, WiseTech Global, software for logistics service providers, also increasingly the customers of those logistics service providers. It's sort of expanding to become that end-to-end logistics sort of software, essentially.
So it does logistics software for like a shipping company or like a port?
Yep.
But then it's expanding to be what?
Really end-to-end. So companies that own warehouses run businesses as well, managing their supply chains, for example.
Oh, wow.
Yeah. So it's really developing that element to it. It's been very, very clear that it doesn't want to compete with its customers. So it's not trying to do what its customers do. It's just trying to extend the support that they can offer to their customers as well, which makes it a lot more integrated with those businesses as customers.
Okay.
So when I talk about end-to-end logistics software, it predominantly operates on the CargoWise platform. I'm talking customs, landside logistics, warehousing, supply chain management, as I said. Supply chain management actually in particular, it's recently announced an acquisition of E2 Open, which is a NYSE-based business, I believe. So based on the New York Stock Exchange. Pretty big acquisition, this one. 2.1 billion, I want to say, US dollars.
Oh, right.
Thereabouts. So the biggest of WiseTech's WiseTech's history. By a long, long way. But what I really love about this business is just how integral it is to its customers. So I'll just expand on one of those examples, customs. So customs, as we know, is already a very complex business. If I'm importing something from China, it needs to go through a whole bunch of different regulations, a whole bunch of different checks.
Tariffs.
Yes, tariffs, the buzzword. I think nowadays it's becoming increasingly complex because of all of these things that are happening in the world. You just said it, because of tariffs, because of different restrictions, importing, exporting things as well. So all of these things need to go through a whole bunch of different checks and balances. Companies that are actually trying to import or export, so think maybe like a FedEx or a DHL or something like that, they run the risk of incurring some incredible fines if they get it wrong. If they do the wrong paperwork, if they don't submit it properly, if they check the wrong box. WiseTech essentially does all of that on its own platform. So it's no longer fragmented. It's a very one-stop shop for these logistics service providers. I love that because it becomes very integral to those customer success. It's also a really great business model in terms of, I think, operating in or being an attractive value proposition in all different market conditions. So when conditions are booming, companies want to access them because they need it to actually manage their delivery, because they're just getting so much demand. But then through tougher periods as well, customers want to access them because it can help them to improve their efficiency. It can help them improve their efficiency, become less dependent, I guess, on human manpower, man hours, but also even just in terms of reducing the fines that they incur, as I said, with making sure that they actually adhere to different restrictions and regulations.
So you're saying it's kind of like a network effect?
I think that's a great way to put it. Very succinct.
Okay.
Yeah.
I just realized I did buy my shares only like 2 months ago. My little amount of shares. Oh.
I think it's probably gone up a little bit in that time.
26%.
There you go.
Basically a day trader.
And a successful one.
Yeah. But I also own it through my ETFs and that sort of stuff, so I'm very happy with that.
Very good company.
I'm no Ryan Newman, but yeah, not bad. I'm pretty happy with that.
Yeah, I will say one of the risks, they have had some governance issues recently.
Yeah.
They are also priced for growth, and they do undertake some pretty big acquisitions, including the one I mentioned before, E2 Open.
Yeah.
So those are a couple of the risks that I would suggest that members or listeners look out for.
Yep.
But otherwise, very good company.
Yeah, that's a bit of a Freudian slip there. The members of the Motley Fool.
Members of the Motley Fool.
Shout out to members of the Motley Fool that listen to this podcast. Hello. Okay, that's company number one, WTC, WiseTech Global number two.
The second company I'm going to talk about is Chrysos.
Chrysos. Now, you've told me about this company before, and in particular, very high level, in like one sentence, what does it do?
Okay, so it's a mining tech company, essentially. Okay,
and the CEO's name is what?
Dirk Treasure, which is the perfect name, I think, for a mining tech company.
And I spell that C-H-R-Y, Chrysos.
Yes, Chrysos, which I believe is Greek for gold.
Oh,
yeah.
Okay.
And ticker code C79, 79 being the
periodic
table number for gold.
Ah, there you go. Bit of an Australian science podcast.
There you go, yeah.
Yeah, okay. So what does it do?
So essentially what it's done is it's replacing an ancient method for testing mineral samples. Now, what I mean by that, we know that mining is an incredibly capital-intensive industry. Mm-hmm. Costs a lot of money. It's also often time-sensitive. So, for instance, during rainy season, maybe they're restricted from actually accessing these mines for 6 months at a time. When they've got when they've got the opportunity to do the mining, they need to take advantage of it. They need to be doing regular samples of the dirt to make sure that they're mining in the right place and actually getting the target of what they're trying to achieve. So it's super important to get these tests right. Historically, they've actually relied on this method called fire assay. That's it's a labor-intensive process. It's also makes the use of a lot of dangerous chemicals. So, for instance, lead. A lot of people who are actually doing these fire assay processes need to be regularly tested for lead to make sure they're not being poisoned. Also, not so friendly for the environment. They can also take about 3 to 4 hours to actually run a sample, and they can run multiple at a time, mind you, but it takes 3 to 4 hours, I think, to actually run one of those fire assay processes. Back to Chrysos. That is a, say, 500-year process, the fire assay. Essentially, Chrysos has introduced this new process called photon assay. And instead of using these dangerous chemicals and extreme heat, labor intensive, it's actually developed this, it's like a shipping container size unit called photon assay. And it essentially uses X-rays to excite the nuclei in the gold atoms. And it can then basically rebound and tell the machine how concentrated that sample is for gold. It can also do that for other minerals as well, in particular silver and copper. It is expanding the number of minerals that it can do, but it can do that in a matter of minutes. You can also prioritize which sample you want to use as opposed to having to wait for hours to actually, to do this. It's deployed about 34, I think, units, maybe a couple more than that. I haven't got the number off the top of my head. I think it's done 34 units or thereabouts, actually deployed. It's contracted for another 18 or 19 units, I believe, which takes it up to about 54, 55 thereabouts. Out of the total market opportunity of 610 units. Now, that might not sound like much. It sounds like a pretty small market, but, and I should say as well, the market in particular is large mining sites and also laboratories that do these tests. But while it mightn't sound like that huge a market, they can only actually manufacture about 18 of these a year. If we consider that a unit might have maybe a useful life of 20 years or so, they will be refreshing some of those existing units before they can actually reach the end of that life cycle, before they can actually meet that total addressable market. That's assuming, of course, they get to 100%, which, it's an out there expectation, but that is to say that there is a big opportunity for growth here.
Okay, so it's not like a hypey stock, is it? I noticed it's got a price earnings ratio of like 9,000 or something crazy, but obviously I never use that to invest anyway. But my point is, it's like getting financial traction.
It's getting financial traction, yeah. Revenue's strong. It costs about $3.7 million or thereabouts to actually produce one of these units. The payoff or the payback period isn't that long. Again, I don't have the exact figures in front of me. I think it might be like $1.8 million or thereabouts of revenue generated per year from one of these units.
$29 million of revenue in the most recent half year.
Yeah. And yeah, so we're looking
fast.
So annualize that's about 60 million, but we're probably looking at more than that. I think they've given an outlook figure as well.
Okay. Well, I haven't got it right here.
I haven't got it in front of me, but it's a rapidly growing business. It's one I really like. And again, I do own shares in it.
Estimated 54% growth.
34 units. We've just seen that on screen.
Yep.
What I will say too is the mining industry it's slow generally to actually adopt new technologies. And when it starts to adopt them, I think that's a real potential for a tipping point opportunity for these businesses. In terms of Chrysos, it did get this really good deal and exposure to Barrick Gold, which is the world's second largest gold miner in the Nevada gold mines. I think that was maybe 18 months or so ago. It also had exposure to Newmont, which is the world's largest gold miner at that same area. And just to provide it with some really good validation, Newmont has actually recently signed on as a customer as well. So they've had the opportunity to assess how the technology is performing at those Nevada gold sites. They've liked it enough to say, hey, we want some of those as well. So I think that's a real validation for this technology to start to expand it over time.
The final company is one that I often see on my favorite Netflix true crime documentaries and docuseries. This company is called Axon Enterprise, AXON. It's listed on the
NASDAQ, yeah.
NASDAQ Stock Exchange. So it's an American company, Axon Enterprise. You can see I've got it up here in the ticker terminal. Company has been on an absolute tear, yet another one that you own.
Yes.
Good for you, mate. But it's been on absolute tear recently. My understanding is it makes the security cameras that go on like the body armor or whatever you call it for cops.
Yeah, body cams.
Body cams. And it does tasers, non-lethal.
Yes.
whatever they call it?
So the company actually used to be called Taser International.
Oh, okay.
Yeah. You might.
And then it's got a cloud-based platform that connects it all together.
Yeah.
So you could determine the security camera footage. I'm guessing you could probably determine if a taser has been deployed and that sort of stuff.
That's the part that I'm really excited about. The cloud-based software that does tie it all together.
Okay.
So you mentioned Taser, you mentioned the Axon body cam as well. These are really good things. They've also got other products as well out there, like drones, for example. They're expanding into cameras for like vehicle-based cameras too. But what really ties it together is that cloud-based platform. And the most exciting one that is really gaining traction at the minute, it's called Draft One. We know that a lot of police officers spend about a third of their time, and this is specific to the US, but I imagine it's very similar in international markets. They spend about a third of their time doing paperwork, report writing. That's a lot of the time that sitting behind a desk and not actually out there paroling. And, you know, if we're patrolling, I should say, not paroling.
Yeah, I was going to say that.
Yeah, you're wrong. Yeah, wrong choice. You've got wrong choice of words. But what I'm really excited about here is that a lot of companies, but also government divisions are starting to look for how they can actually find efficiency improvements. This is one of the best ways, I think, that I can think of that companies can do that, and certainly police force and other defense units. Rather by basically using inputs from the taser devices, also the Axon body cams, that basically push information to this Draft One program, which can then draft up that report itself. So let's say 12 hours a week, a general 40-hour work week, 12 hours-ish spent on report writing. What if you could narrow that down to 1 or 2 hours?
Yeah.
That's a big, big saving. And just that ability to integrate both hardware and software makes this such a sticky solution for those government units. 123% net revenue retention. Basically, what that means is if I'm a police department spending $100 on Axon's products this year, in 12 months' time, on average, most of those units would be spending about $123. So just expanding within existing customer bases, but also expanding further into other divisions as well. Different, for instance, retail are starting to pick it up. International is a huge opportunity as well. So big optionality for this business.
Every time you just keep saying another point, I'm just getting more and more annoyed at myself.
For not purchasing it?
Yeah, because I looked at it so many years ago and you can see on the screen here, like its revenue just since say 2018 has gone from 400 million to 2 billion. Gross profit's gone from 260 million to 1.2 billion.
The shares aren't cheap, I'll say. Like the shares have gone up in price a lot too, in terms of valuation.
It's gone from $5 a share. When was this? That's like 2014.
Yeah.
To $50 by 2017. That's $23. That's when I was probably looking at 2017. And that's $700.
Yeah. I didn't own it back then,
what an
I have to say.
Idiot. What an
Yeah. I wish I had have owned it from $5, but didn't. But yeah, it's a very good company.
Wow, that's a good one. So Axon, AXON, it's an American company. We talked about WiseTech and we talked about Chrysos. What was Chrysos? C79.
C79, yep.
Good businesses. They all have risks, so be sure to do your research. You can subscribe to the Motley Fool, actually. There's a free website, fool.com.au. But Ryan works on the paid services, which, if I'm not mistaken, are 2 services that you work on.
Yes.
Motley Fool Pro, which is closed to new members.
Yep.
And then the other one is North Star.
Correct.
North Star, which is opening in July.
I believe it's opening in July.
We could be speaking out of turn, so be sure to confirm with the Motley Fool itself.
Yeah, typically we only really market North Star to people who are members of one of the front end services, so Share Advisor or Dividend Investor.
So you have to get one of those first to get into
typically,
this one.
I would say though that if any of the listeners are interested in joining North Star, I would say and don't have access to Share Advisor, first of all, by all means,
get Share Advisor.
Yeah. But also, if not, I would suggest you can also reach out to the member services team. You can find the email address on fool.com.au and just mention, I'm interested in joining North Star. Can you include me in the marketing campaign?
Yeah, cool. Like it, mate. Well, Ryan Newman, Director of Research at Motley Fool Australia, you've brought us 3 really good companies to kind of put on the watch list. 2 of them we've never really spoken about. So really appreciate you taking the time out.
Been great being here. Thanks for having me.
Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel. Or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.